Understand financial market structures of debt and equity markets. In this article, we will continue the financial investing series with the discussion of financial market structures known as debt and equity markets in macroeconomics. Debt markets. Fund borrowers can utilize debt instruments like bonds, debentures, or mortgages. These financial instruments are legal documents that require the borrower to pay lender certain amount of interest payment until a maturity date. The maturity date is the date the bond's expired interest is paid at stated intervals until the maturity date, whereupon the borrower repays the principal. The debt instrument can be A short-term instruments require 1 year or less for repayment. B medium-term, it can be repaid between 1 and 10 years. C long-term, it is longer than 10 years to repayment. Equity markets. The equity market raises funds by the issue of shares that create ownership in the corporation. There are different types of equities markets. 1. Primary markets. Only sell new issues of a security. Brokerage houses act as intermediaries and underwrite the securities by guaranteeing the price by the corporation or government issuing them. Initial public offerings (IPOs) are usually pre-sold and not available to the public. 2. Secondary markets. Resell securities that have already issued through the primary market and they are sold in open market without a price guaranteed by stockbrokers and dealers. 3. Exchange and over-the-counter markets. This is the stock markets that arrange for buyers and sellers to interact in one physical location. 4. Over-the-counter markets (OTC markets). Dealers hold an inventory of securities that they sell over the counter to anyone willing to accept their prices. Money markets. Money markets trade securities with short maturity dates, usually of 1 year or less. 1. Government treasury bills (T-bills). These are debt instruments purchased by corporations, other governments and consumers to finance federal government deficits. 2. Short-term government bonds. These are bonds that have a maturity date of less than 3 years and carry a fixed interest rate. They are equal in security to a T-bill. 3. State and municipal short-term notes and bonds. These carry interest rates that are determined by the credit rating of their issuer. 4. Banker acceptances. These are bank drafts issued by a firm. They have a stated maturity date, usually 30 to 90 days, and can, for a fee, be guaranteed by a bank. They are also virtually risk-free. Capital markets. Capital market instruments include the following. 1. Stocks. These are equity shares in a corporation. 2. Government bonds. These are long-term debt instruments that have specific maturity dates, interest rate, and are highly liquid. 3. Savings bonds. These are sold directly to the consumer and always maintain their face value and may be cashed at any time. 4. State or provincial bonds. These are issued by a state or provincial government. 5. Municipal bonds, issued by local governments and often used to finance specific projects. 6. Corporate bonds. These are used to finance short or long-term activities. They have a lower credit rating than government bonds, hence a higher interest rate. 7. Warrants. Warrants are certificates that give an individual the option to buy a stated number of shares at a specified price for a specified period of time. Foreign exchange market. In the foreign exchange market, currency is bought and sold,